If they start to see unemployment tick up, people losing their jobs, inflation continuing to come down, then they can cut interest rates. Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Fed officials give us some optimistic news this week. Interest rates remain high, and the stock market begins a slight decline starting for the month of September. Short trading week, let's just dive right into it. So I'm going to go over a couple things that the Fed official chief and a Fed official president said. And when I'm referring to these Fed officials, these are the folks that decide on our monetary policy. They either give their insights, their analysis to the voting members of the Federal Reserve. And some of them are part of the Federal Reserve. So they're voting and deciding on what they're going to do with monetary policy. And when I say monetary policy, I'm referring to either interest rates, they can tighten interest rates, they can lower interest rates by cutting, or buying assets on the open market. So typically the Federal Reserve will, when they're trying to be supportive of certain markets, they'll go in and buy assets. They'll go in and buy debt, raising the price of the debt and bringing down interest rates, or vice versa. They can sell off debt, and what that does is it brings the debt value down and interest rates up. So remember a while ago when I told you guys about the interest rate and bonds, which are debt phenomenon. So it's a seesaw. So if debt and bond prices are going up, interest rates are coming down, and vice versa. If bond prices are going down, interest rates are going up. So that's how they control monetary policy, either by raising rates directly or buying and selling debt securities. And that's how they control that monetary policy, making either interest rates going up or going down, so it's either harder to get debt, harder to get money, or easier to get money. So I'm going to go into a couple things the Fed officials said this week, since we had a pretty short trading week. And let me pull up one on your screen here. This is Fed official New York Chief Williams. And he said, hey, policy is in a good place. That means it's restrictive enough right now, but they must be data dependent. And what we've been saying all along here is they're going to continue to be data dependent on what they're going to do with interest rates. Or they're going to cut. I think they're in a good place right now. It's restrictive enough. We're starting to see some cracks in economic data. But they want to maintain it as high as this level as long as they can, so inflation doesn't come back up. If inflation starts coming back up, then they have a problem. They have to continue that fight against inflation by raising interest rates. Now, being data dependent, if they see a spike in inflation, they're going to raise interest rates. If they start to see unemployment tick up, people losing their jobs, inflation continuing to come down, then they can cut interest rates. But that cutting is still a long way off, and they're going to try to keep it as long or as far out in the future as they possibly can, because they don't want to pick up this fight against inflation again. And how do we know that? Let's pull up what another Fed official said on your screen here. This is Fed Goolsbee, and he is the Federal Reserve Bank president. And what he said was the overall level inflation is still above where we want it to be. So what is he saying? He's saying they're going to keep interest rates at this point until, unfortunately, and if we look through history, they wait until things break, and that's when they start cutting rates. So they're not going to just preemptively cut rates because it's too risky to preemptively cut rates. They need to keep rates high. They need to continue to slow down the economy. They need to see employment tick up. And unfortunately, there's going to be some fallout and ramifications from that from businesses. They can't get money. And let me put on your screen here this last slide here. That's 9/8/2023. The 30-year fixed mortgage national average is 7.55. That's 7.55% for your 30-year mortgage rate. And that's with really good credit. And that's the national average. I mean, it's going to be, you're probably going to be seeing some in the 8%. maybe in the low sevens if you have really good credit, you put a lot of money down. But overall, interest rates are very high compared to what prices are, especially in the real estate market, that single family housing market. When you have low supply, you have high prices, high interest rates. So either interest rates have to come down to get the real estate market to be healthy, or prices are going to come down. So one or the other is going to take place, and the latter possibility that's probably what's going to happen, because they're going to keep rates high as long as they can. So the sooner we realize that, the better off we're going to be as investors. There's a lot of opportunity out there, but here's what's going on next week. Next week, we have consumer price index, more inflation data. That's what's going to drive the rest of September. That's what's going to drive that monetary policy. Probably it's going to make that rate decision the following week. So we're going to have one more inflation data, and then we're going to have the Fed interest rate hike decision. And something to keep aware of is energy prices have ticked back up. So let's see if we see that in the data next week. We'll tune in, we'll talk about what that CPI data what said and what we need to do with our investments. If you found some value from this, please do me a favor and like and subscribe at that button below, and tune in next week. Expertise you deserve, experience you can count on.